good evening, everyone, for joining in. Thank you, Trey and John, for joining in for our webinar today. We're here to discuss one of the most pressing topics in the industry today, which is influence of economic factors of mergers and acquisitions. Well, to start off, I'll introduce myself. So I'm Arshya. I work with sales and strategy team at MergerWare, and I want to introduce our panelists today. So we have with us Bartholomew, who's the head of corporate development at LEK. We have with us Trey, who's the vice president corporate development at SAP. And we have the founder and CEO of MergerWare, Dharmendra Singh, with us. Thank you all for joining in today, and I'm glad that we are all here to talk and discuss and understand your viewpoints on the M&A market today. Well, to start off with, we understand that yes, the pandemic and the current situation in the world has been off the track, and everything's been very haywire. The status quo has changed. We saw that the M&A market in 2021 was huge. There were deals of 1 trillion, but in January and Feb, when the COVID struck, they plunged to 15%. And when we talk about the current situation, with the Russian aggression, so we saw that Europe suffered a lot. And with that being said, every country, there is an underlying scare of recession. There is an underlying scare of, rising inflation. The interest rates are high. Private equity is in a problem situation because the returns are really low. So we're here all in all to understand from a broader perspective from both of you, how and on a ground level, how bad the situation and how things can be mitigated in the M&A market. So to start off with the first discussion pointer that we have for today, which is the impact of Russian and Ukrainian war in the M&A market. Would love to know your thoughts, Dawn.
Yeah, so thank you. Happy to be. I think that the way that we're viewing it, obviously we're looking at our legal teams looking at where different companies are getting funded, where their ownership sits, and taking that into consideration from an investment standpoint. But even more broadly or economically, we're looking at the slowdown impacts on the economies in Europe. And when we're looking at targets or pursuits there to serve that local market, we're kind of being a little more cautious with those regards.
Definitely a lot of caution at the moment. SAP found itself in kind of a very difficult situation as we have employees and offices in both Ukraine and in Russia. Obviously, with respect to Ukraine, we've been working hard to try and make sure and we've taken care of our employees. Things were obviously seriously disrupted there, and I think it'll be quite some time before, there's any sense of coming back to business. And then in Russia, with essentially everything shutting down, that's been very challenging as well. In the broader software world, it creates a lot of issues around customers who are on cloud versus customers who are on-prem, what to do with customer data, where do the data centers sit. There's a lot of complexity around that. And I think as we move forward, we've been dealing with export control restrictions for years. Now those only get much more complicated in this environment. As not only have we introduced new countries, Russia and Belarus, where you have restrictions, but those restrictions seem to be fairly fluid. And then in response to those restrictions, Russia's creating its own new regulations and restrictions. So it I think is a very challenging environment, particularly as Dawn mentioned, throughout Europe. It's creating a lot of uncertainty. And then even beyond the realm of Russia and Ukraine, I think it starts creating some complexity, uncertainty with other countries. So doing business in China right now, that's a little tricky. You want to be able to pursue opportunities and things that were already in the works. But obviously there's some concerns about if things change, escalate. Nobody saw us where we would be today, a year ago, and who knows where we'll be a year from now. So it really is, I think it's making everybody pause a little bit and try to be more cautious than normal in any of these kind of circumstances.
That makes absolute sense. And then Dharmendra, if you have anything to add here, when we talk about how the different, the trade routes, and it's become challenging in this current times.
Right. So primarily when I look at, due to current situation of Ukraine, I was just thinking that when we do the, basic due diligence, I know the work of our legal team have increased, right? So if you are a buyer and you are looking at, and you have impact of, Ukraine, you have offices, you have any manufacturing facility, for you, it's become really tough because you have to spend time, try to weigh all the, take out all the risks to make sure that your initial DD is making sure that it is done. And also this is a puzzle where whether to go for DD, how we'll do that. Of course, that country might not consider for some time, but then there are inherent risks, and it is, legal team have to work really hard to get way and really give the clearance. So I think that is one impact I see very vigilant. Like most of the time when I, talk to people who have some business in Ukraine, they have this challenge now.
Yeah, and I think from a diligence perspective, that's probably going to continue to get more and more complex. We've seen in past deals when you look at where the developer sat, and going back a couple of years, all of a sudden you had to be concerned if the developers were sitting in Crimea. And now obviously that geography has expanded quite a bit, and you'll be looking at where was the development done, who owns it, how can it be transferred, can it be transferred? It's going to create a lot of complexity there.
Yes, and as rightly you mentioned, the development team, I mean, there would be now certain instances where companies would go to, other countries to understand and set up back offices. But that being said, the after effects of pandemic and the war situation, I think physically monetary policies have also been really tightened. So what are your thoughts on, the rising rates, and how is that affecting on a financial scale?
So I think in the broader M&A world, interestingly, I guess it was a little bit of a surprise to everybody as the pandemic rolled in that the M&A just kept going. And in fact, if anything, in a lot of respects, we saw it accelerate. And throughout 2020 and 2021, they were certainly very busy times in the M&A world. The shift from doing deals to doing deals virtually seemed, at least for me, seemed to happen almost seamlessly. We just kept driving and just adjusted quickly. But all of that was in a, very low interest rate environment where there was a lot of far more than normal funds flowing. The liquidity was kind of off the charts. And now I think, it's taking some time, but we're starting to see the effects of inflation and tightening monetary policy work its way into M&A activity. I think has been and still remains a lot of money on the sidelines that folks are trying to find a good way to deploy. But now as deals are moving and folks are looking for financing, it's becoming a little bit tighter. Something that was basically a non-concern for quite some time and was essentially freely available and driving a lot of deal work because it was so cheap is now a factor in the deals that we're seeing. So it's playing into valuation a bit. It's playing into deal certainty, and I think that's going to continue as the monetary policy continues to tighten and interest rates continue to rise, at least for a little while.
Yeah, I agree. I think we're seeing, or we're expecting to see as a result of some of this, a little bit more, and this is because of the economics in general, a little bit more of a slowdown of the competition from private equity on a lot of deals. Typically with our size and the stuff we were looking at services, we wouldn't see a lot of PE players like 10 years ago, but they've been very active in the space. So I think we're expecting like a little bit more scrutiny and diligence to be having versus, getting something and being told you got like a week to respond. So I think that the secondary impacts we're expecting to see. And then in general, I know we've been talking about different opportunities from a board perspective, and anything that would, require, we're a very conservative company, that would require us to refinance our line or do something like that. We're definitely thinking twice about, just because it's more expensive.
Yeah, and I think it's giving a lot of pressure on the, as you rightly said, private equity firms to give returns, because there's higher, investor capital in the market right now, and everything's data driven. So yes, completely, it's a highlight to be pointed out. What are your thoughts, Dharmendra, on this thing?
Yeah, so whenever we have this, interest rates rising, I think deal are going to happen, right? Deal will never stop. But I think as if you look at the process, the way we have been following up, now we have to be, scrutinize it better, make sure that, the deal flow, whenever it comes, we really start working on that. So I think we'll continue doing the deals, but then there are lots of, check and balance, and deals are going to continue. So as either we have private equity firms or corporates, deal is bound to happen, but pressure is on. We have to be very careful while doing the deals.
But I would throw in just one comment that to some extent, I feel like there's a bit of this bringing back a sense of normalcy, or at least a little more reality. If I can, at least in the United States, if I can equate it to the real estate market with low interest rates and a lot of liquidity in the market and a lot of government funds that were out there, the real estate market got overheated to the point where homes were being bid up way above the asking price. People were doing a transaction, waiving all their all their rights in advance. They were not doing inspections, and essentially, relating it to an M&A context, they were waiving a lot of their diligence rights. And there was some bit of that in the M&A market where things were moving so quickly, prices were getting bid up. There was an expectation of deals happening very quickly. And we're, as Dawn mentioned, SAP is a very conservative company. We always want to do our diligence. We always want to take our time and be thorough. And that was getting hard to do in that environment. People had expectations of doing deals in 30 or 40 or 50 days, and it's hard to compress everything in there. It's also essentially moved everything to the rep and warranty insurance world. I mean, at this point, PE stepped in and they were very comfortable quickly with doing rep and warranty insurance, but I think it took the strategics a little while to get caught up to that. At least it did for us. But now, there was a while where it was like you were not competitive in a bidding process if you weren't doing that. They wouldn't do the deal with you. Now I think a little bit we're seeing some of the escrow work come back and things like that. But I think this, while this is slowing things a little bit, I think it's also bringing back a little bit of the normality to what at least I experienced previously.
Completely agree.
Right, and I think, as you said, PEs do you think they have started, like PEs, like the general, I would say that they've been adapting, is that taking up complex risks, complex deals, which are like highly at risk and which are very much data driven. So I think, yes, that complex, the market is slowly and steadily, getting back to normal. But do you think, is that a great strategy to follow?
How about if I let Dawn take that?
Yeah, I'm sorry. I kind of missed what you were asking about. Sorry.
I meant to say that, now PEs have, understood the fact that, there are clients that are looking for greater returns. And we saw that, the market is strategized towards taking up more complex deals, much high at risk deals. So, because everything is so data driven. So do you think that is the general, strategy that firms are following, or, it's just something that's still underlying?
I mean, I think there's still a lot of appetite out there, and there's still a lot of money on the sidelines, both from strategic and equity. That the actual scrutiny is going to be, the valuations are going to come back, and more the deal terms, even more so than the valuations. I mean, we're seeing Ps flipping things that they maybe had 2 or 3 years and hadn't even really created a lot of value out of. But they were able just to kind of like turn them around. I think we're going to see that kind of slow down. I've heard too, like private equity it's going to take a longer time to deploy their capital. They're going to hold on to things longer. So I think that takes some pressure off of just everything. Some of the things that I've been looking at. I mean, I think Trey probably sees different things in the digital or technology space, but for professional services, to see something that is negative EBITDA and people are throwing 3 times revenue offers at it, it was kind of crazy. It's something we can't even think of. But we were seeing that recently on a couple deals.
Yeah, and I think to add to that, we're probably also seeing, I mean, I think we're seeing it in the markets, but now I think we're seeing it in the M&A world, sort of a shift in thinking from just a growth opportunity to everybody looking at profitability, and taking some risk off by saying we're not going to buy growth for growth's sake. We're looking for something that's actually a decent return here. So I think that's brought there'll still be those deals, but I think that it's bringing the risk level down. I think it's bringing people are looking to play it a little more conservatively.
And the market's been extremely volatile, I think, and now, of course, yes, it is coming back to normal, but given situation, the volatility is high. But at the same time, there's an underlying pressure in the economy, to say that there is a unprecedented prospect of recession in the US for the M&A activity. So just wanted to know your thoughts on it.
So if you ask 10 people, you'll get 10 opinions on what's going to happen with recession. Some people would say we're already there. It's already started. By some stricter definitions, we're not, but we're probably heading that way. As I'm sure a lot of it, there's so many variables at the moment. There's a lot of pressure on the Fed to try and create this, this soft landing. Whether they can do that or not, who knows? It's a kind of very unprecedented, interesting environment, because it's like not the typical recession, because we still have fairly strong employment. There's still, decent earnings out there for the most part. We're kind of recovering from the massive flow of government funds pretty much around the world into the economy. So that's still sort of playing through. And how all of that impacts, what would otherwise be probably a fairly typical recession, if it happens, it kind of is very, very hard to say. If I had to venture a guess, I'd say we probably do have some form of a recession late this year, early next year, but it's probably a bit shallower. And I was listening to a podcast a little while ago, and it was interesting because they were talking about the younger generation of workers. I'm a little bit older, but some younger workers who have only experienced 2 recessions in their life so far, one of which was the financial crisis, and the second one was the pandemic, both of which were very, very much outliers, right? And so we're not in the situation of the financial crisis because banks have have been stress tested and they're okay, and there is liquidity in the market, and we don't see those factors that really crashed it back then coming to play. And then the pandemic was its own thing and completely unique. And I don't know that we'll ever see that kind of sharp recession and almost immediate recovery again. So I would think if we have one, this one will be more typical. And in that environment for M&A, I think, at the moment, everybody's probably pretty cautious because everybody's preserving capital and trying to see what it's going to look like in 6 months or 12 months. But at some point, just like in the overall stock market, it's going to turn into a bit of a buying opportunity. Things are depressed, prices are better, multiples come down. And I mean, I can say things that we looked at a year or two ago are, almost on a half off sale now. And so they start becoming interesting again. And if it didn't make sense before, maybe it starts making much more sense now. And I think, I don't know when the timing is going to happen on that, but I think pretty soon, probably later this year, we'll see some uptick in M&A activity as people start finding good opportunities. Because I mean, it will be a good shopping opportunity.
Yeah, I agree. I mean, I don't think that it seems like it's going to impact different businesses in different ways, so there's still a shortage of talent. There's still, and I think internally, we've also been running really hot. I mean, our partners are incredibly, behind the ball. I mean, they're working extra hard. So there's a part of leveling that's got to happen, but it's still going to create great growth opportunities. Our strategy is still the same. Nothing that's happened in the world hasn't changed those underlying factors. So we're still going to look for great things to expand our capabilities. But I do think just even as an organization, it's kind of like we're hoping to kind of like diffuse some of the pressure that we've been operating under. Because, in my prior firm I was with too, Spencer Stewart, it's the same thing. I mean, they were growing at like 30-40%. And in people-based businesses, it's just more difficult to scale that way. So I think we're hoping it kind of like level sets, and then we can kind of get on with our plans.
I mean, do you have anything to add here when it comes to,
Yeah, so I think Don and Trey brought very good, important points on, putting the pressure, making sure that this is you can say this is temporary, and still lots of investment governments are doing, even if you look at in India, the market, right? Lots of M&A deal happening now. Government have focused on larger investment this year. So I think by end of the year, things will get stabilized. And this pressure on the news, what we are seeing, this may be a temporary one. It is going to be, a stronger year, even this year, last quarter, and the coming year. So I feel that this is just a starting point to be, stabilizing things and be prepared for better future for M&A.
rightly said so, and great points, Ron, Trey, understanding how, yes, we are sort of, I think, pressure tested by seeing these two outliers, in the past history. So yes, definitely we're in a situation where we're set up for success. And as the year proceeds, I think M&A market is going to stabilize and, have a great opportunity for, everyone to invest in and understand. While that being said, I'm going to take another stance here and understand that, now companies are also checking in and making sure that, when they are trying to understand a part of deal, when they're seeing a potential deal. So they look at the ESG comparatives that the company is doing, what sort of sustainability measures they are undertaking. So, what are your thoughts on it, and how is that going to create that economic value for the firm in the M&A market?
Do you want to go first, Don?
Sure. So, I mean, from an ESG perspective, I think, we are starting to look at sustainability, but I think even more so, we're a people business. So we're paying close attention to diversity and to different culture programs and so forth as we start to bring other companies in, because we're working on, creating a cohesive LEK experience, and we don't want any outliers from that perspective. So that's how kind of we look at ESG when we're looking at business opportunities.
Yeah, I would agree. I think, more and more, not only is it, very important to the company itself, for SAP worldwide, and how we run our business, but that plays through into diligence and in an acquisition. What's a target doing? What's their workforce look like? Are they embracing diversity? Are they actually taking steps to kind of manage ESG within their own company, so that we're not creating issues for us in an integration phase as post closing. I think at the moment it seems to track very similar to things like compliance and export control, where when you look at a company, kind of depending where it is in its growth phases, you have different expectations. When it's just a small startup, there's barely any bandwidth to manage any of that, and your expectations are a bit lower. But as they grow, you certainly expect that to be part of the growth of the company, and that they should be managing that. And we look in diligence to make sure that they're taking effective steps to embrace ESG as part of their overall growth strategy. And I guess one other thought I would say, I think that's going to become even more important, as at least in the US, as the SEC has taken steps to start actually pushing this into regulation. It's going to become an even more critical piece. I think socially, it's a very important piece for the companies to be managing that as part of your overall management of the company, but it's going to become more of a legal factor as well, as it plays into the regulatory aspects of diligence and doing deals. So
yeah,
even if you wanted to, you will not be able to ignore that going forward. But I think by and large, we're seeing a very positive response in most companies to embracing that.
Yeah, but yeah, I agree. I mean, we're kind of looking, and continuously as a global organization, we're signing up to different commitments on what we're going to do from a sustainability factor. So we have to factor all of that into, the deals and the metrics and what types of organizations we work with and we acquire.
Right, and rightly pointed out that now that is essentially a very critical factor as of today in the market, to understand what the company essentially is doing for these considerations. Would love to know, Dharmendra, what do you think is the situation here in India and the Asia markets? How important do you feel that companies are taking that into consideration, given that there is less regulation around this?
Right. So right now I can say that ESG is part of mandatory key action item whenever you are doing any M&A deal, and that you start from the beginning of the deal till integration is fully complete. The idea is, and that includes everything, right? Diversity, every senior management have been given a specific goal to, and these are monitored by corporate level. So I think that is making sure that we are not missing this important thing. So KPI, if you have to measure, then ESG is part of that. And that is good. I see ESG became more part of your M&A playbook itself. And people are following it, and it became more mandatory than, just a choice. There is no choice. We have to do it. So companies are adopting very well. And I think there is lots of enforcement. Somewhere regulations also, empowers you to do. So overall, in Apex market, if you look at, there is a strong push for ESG in general, making sure that it is become more, mandatory key action item for any deal makers. Yeah.
Right. Any other point here that we're probably missing out on? Something I know LEK is doing that a lot, and Trey also. Anything that we think we're missing out here when we talk about sustainability and ESG considerations?
Anything we're missing?
No, I mean, in the sense of like, any other consideration, do you think apart from these or within these, like, companies are probably, undertaking currently in the market at a ground reality level?
Hard to answer. But I mean, I think as everybody's talked about, it is becoming more and more of a factor. I think, from the top down, you look at the meetings that happened at the World Economic Forum. It was one of the big topics for that whole group, and as that cascades down, I think it's going to play throughout the market. And I think, as we look at opportunities, it will increasingly become an important factor of the various things we look at in diligence and we look at in doing deals that, what makes sense. That's going to become, ever more important.
Yeah, I think as the standards start to really evolve and kind of get more firm, it will be, it'll be a bigger part of collecting the data on these companies. But we're kind of at the beginning stages.
Correct. Yeah, I mean, yes, it's an evolving journey going, in this, and given that it becomes one of the key performance indicators as of today. So while that being said, if I have to deep dive and understand it, we talked how how we have to set up for success. There are M&A playbooks. There is a strategy that goes around the market. So with that being said, there are different roles and there's certain ownership when it comes to an M&A deal management. Something that the market's been observing, that there has been a shortage of talent. Having the right kind of person, having the right set of eyes, and that having that environment set up. So what are your thoughts on retaining the right talent and that having that ownership of the folks leading the strategy?
It is absolutely fundamental to everything we do. I mean, and especially now. I mean, we would probably be very less likely or hard pressed to do a deal where the beneficiaries were not owners or were not key people that were staying on as part of the transaction. We look a lot at that. That's one of the first things we ask about is the ownership structure, putting in the right deal mechanisms. But then as part of that, it's understanding their whole team, their culture, their career trajectory, what are their retention rates, and making sure that even though it's much easier to bring things in-house and make them all look the same, where do we need to kind of keep things separate for a while to make sure that we retain it, we understand the key drivers of their business from a people perspective and what keeps them there versus trying to force something in. So it's kind of, I think this is an approach we always had before, but we're even, focusing on it more so that we make sure we don't lose the talent because it's so hard to replace.
Yeah, I agree. It's critical in the deals, and it's critical. I would say, there's a couple aspects through the M&A process that I think have really taken on a lot of importance over the last couple of years with talent retention. One is how is the target company managing it themselves, and as a diligence item, trying to understand. Have they been able to retain their talent, or have they lost talent? Everybody talks about the Great Resignation and people finding other opportunities. When you look at a target, it's like, do they still have the critical people now? Have they retained their key talent? And then bringing them in our case, bringing them into SAP, what does our retention strategy look like? That's gotten more challenging. And how are we going to make sure we retain them for at least a couple of years to make sure the integration works smoothly? I think people have felt a greater sense of ability to move around a bit, and it's made all of that much more challenging. The other thing that I think it has now played in is everybody going virtual, nobody being in the office. Now companies are trying slowly to get people back to the office. Again, when you look at a target, it's like, how have they managed that? And how are we going to manage it going forward? In some cases, it's made things easier. You go in and everybody's been working remotely, so it's created some situations that are easier to move people over. You're less concerned about things like facilities and real estate leases and all that. But then as we slowly kind of start to shift back or shift at least into a hybrid mode, how are those employees going to respond to that? And how are we going to be able to work them into our culture and our environment? And, you know, at some level, you want to retain that flexibility because it's part of, you know, employee satisfaction. And for some people, it's a critical piece of what they're doing. But at the same time, you want them to get plugged into your own culture and meet the people and collaborate in offices like we did a couple of years ago. And that's becoming very challenging to get people into those spaces and get them working with the company. So a lot of, you know, pros and cons, but a lot of new things to navigate in the process. So net, I mean, personally, I'm a fan of the hybrid situation. It's nice having flexibility. And personally, I think SAP's done a good job of trying to navigate that. And I think target companies appreciate that as part of coming into SAP, that we continue to allow that flexibility, but it also creates some challenges in making sure folks are feeling integrated into the company and feel like they know what they're, you know, they know who to call for certain things, they know what to do. I think these challenges are going to persist for a while.
I would say from a diligence perspective, it is so much easier to be able to sit in the room with potential, you know, sellers. We worked on some deals and did some things during the pandemic where everything was virtual, and we missed a lot. So I think that importance of really getting to know them, having dinner with them, like understanding who they are as people and understanding their key drivers, and then also sit in the room and see who actually kind of knows the information when you ask the question. It's so much easier than on a Zoom call when it's all kind of, you know, there's just bits of interaction.
Yeah, there was a very bittersweet piece to doing the first couple of deals completely virtual. It was, you know, you were impressed that the team was able to actually pull it off and do everything virtually all the way through to like doing our board approvals and everything virtual. And at the end of the day, you're like, oh my gosh, we pulled that off. That's kind of insane. But the flip side, Dawn's totally right, is there's a lot missing in that personal interaction of, you know, spending a day with the other team, going through all the diligence stuff, then going out to dinner at night, getting to know these people a little bit. It really does a lot for how a deal goes forward. And I'm glad to see us getting back to some of that.
Yeah. So I think I had some experience while, you know, where we met the team face to face. I think that was the best experience for, you know, retaining, knowing people, because, you know, when you are doing due diligence and everything is virtual, it's very difficult to know each individual, right? So even you are doing retention planning and all this, all, you know, you drop an email and, you know, maybe HR talk about their future retention plan, the bonus and all. If you make it more physical, where we see face to face, I think that impact is very high. And I have seen most of the deal where success were higher, they were all where people have several interactions during DD phase, during day one, and, you know, even dependency planning. Everyone, you know, representing from a buyer and seller side, you know, sitting together, discussing about the dependency. And also retention become easy. We know exactly who does what. And then, you know, it's a kind of a cross team interaction become, you know, much easier. So I think impact is always better, but I think now due to current situation, last 2 years, most of the diligence have been completed by, you know, virtual Zoom meeting. So I think that is one way of doing, but always it is best to have face to face, because that outcome is better than, you know, just doing remote.
But personally, I think there've just been both pros and cons to the whole situation. People have, probably moved on the lines of working in silos also, because that is also they're working on their own. They don't like have that due diligence in place, and when going through an M&A process, it becomes very essential that that dependency and who's working on what is that org structure, and that ownership becomes extremely essential. So, and with that being there in the market, it has also urged folks to be more digitized, like look into virtual data rooms, as Trey mentioned, right? Having that entire legal everything, having that whole deal being done virtually is commendable. So yes, dependency, I think, on technology has also urged a lot. Companies are moving towards digitizing the whole process alongside having a hybrid model, meeting client to face, but the digital mapping, I think, it has been tremendously upwards. So anything more to add in, Don, from your thoughts, Trey, from your perspective on this topic?
No, I mean, I think we've covered a lot. I think, these are very interesting, challenging times. I think, there's been a lot that's happened over the last 2-3 years that people didn't expect, from the pandemic to Russia invading Ukraine, to all the government funding that went into responding to the pandemic, and then pushing inflation, and now is trying to respond to that. There's a lot of factors going on, but overall, I think M&A remains strong and very active. I think it remains a key part to a lot of companies' growth strategy. I think in the private equity world, there's still a lot of money out there, and there's still a lot of pressure on the private equity firms to do good deals, and make strong investments, and that's still creating competition in the market for doing these deals. In some places, I think that's been a very positive factor. For example, in rep and warranty insurance, personally, I think that that's actually been a very positive development in the M&A world and getting deals done, and a lot of that's been pushed by the competition from PEs, and I think that's good. In other respects, I think it's made things, some things more difficult, but I think it'll be interesting to see how, the next year or two play out as we come out of all of this and start moving forward. I think a resetting on looking at opportunities, again, that are profitable and not necessarily just quickly growing, probably is net a good thing. And we'll start seeing good opportunities at better valuations. So I think it's going to take some time, but I think there's going to be a good positive outcome out of this a year down the road. I think folks that are looking for kind of the diamond in the rough now, you can find them at a pretty reasonable valuation, and those things will pay off and hopefully make generally the economy and all these companies stronger in a year or so. So interesting times, but I think, probably a rough couple months ahead. And then, I think things will start really settling down and improving.
Well, I great point. Thank you for summarizing, Trey. I think, as you said, great time, interesting times, and there's a lot for us in the road ahead to understand how M&A market will evolve. And while these factors that we discussed today, they play essential roles, and with each and every factor, there is an opposite. You would see action that you would experience in the market. So just wanted to understand that. Do our attendees have any questions for our panelists? The forum is open. You can type in any question. But I think our participants have clarity of thought from both our panelists and just wait a minute more if anyone has any queries or anything they want to deep dive in. But I don't think they have any questions for now, but thank you so much, both Trey and Dawn. I think these were great, points and these highlighters, which our viewers and, everybody who's there in the M&A market is already pondering upon it and, definitely having strategies in place and both for SAP and LAK. So thank you so much for your time today and for giving us your valuable thoughts.
Yep. Thanks for
Thank
having
you.
us. Thanks.
Thank you.
Dharmendra, do you have anything to add in?
No, thanks. I think we have covered most of the points, so I don't have any other point. I think I see some questions somebody have sent.
Oh, good.
Can you provide more light on multiplier of revenue for M&A? So Trey,
Especially in tech
for you.
space.
Yeah.
Yeah.
in tech.
Honestly, I think so obviously the multiples were high. They'd gotten kind of crazy. We've definitely seen them come down to at least a little more reasonable valuation. But again, to a point I was making earlier, I think we've seen a shift in focus from pure revenue multiples to EBITDA multiples as a better view on what's a reasonable price. So I think that the shift from growth, viewing or looking at growth as a prime driver to actual profitability is playing through and how folks are looking at some of the multiples. So definitely they've come down. They've gotten to a better valuation, but I also see a shift in what folks are looking at as the right multiple.
Yeah.
Right. I think that was answered. Anil, any other questions that we have from our attendees before we? Okay, we got a thank you too. Thank you, Trey, and thank you, Dawn. I think
you.
that's it from our
Thanks.
attendees.
All
Thank
right.
you.
Yep. Thanks.
Thanks,
Bye.
Trey. Thank you.
Have a great
Bye.
rest of the day, both of you.
Have a good day.
You too. Bye.
Bye.